Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, February 2nd, 2024. It's 11 o'clock a.m. Eastern Times. I'm starting the video, and what I'm going to do in this one, I just got back from an appointment, and I'm going to do a brief update on the big three. And that is, of course, the euro-US dollar pair. Currencies really have a big impact on the stock market, whether you want to trade the currencies and gold and silver as well. Then treasury bonds or interest rates, very, very important right now. And of course, the stock market. Those are what I refer to as the big three: treasuries, forex, and the market. All right, so we're going to start out with QQQ. QQQ up today. Same story, and I know there's some excitement on the board, especially got a couple vocal folks lately. And I'll talk, and I want to address those comments. Look, guys, I welcome all comments. I'm going to give you my thoughts as I always do, and then you guys decide what to do and how to take that analysis, incorporate it into your own trading or investing. So to be clear, we still don't have that trend line break or that sell signal that's pending on QQQ. We have a very clean uptrend line. We hit it and closed on it yesterday. We actually, for active traders, it was posted as a long trade, and this is it right here on the 60-minute chart. Perfect tag, objective long entry, and we're back where we were before I left my desk this morning in pre-market. We were there. So I want to reiterate what I said then, and it holds true. This is just my take, my plan. This is an objective shorting level kickback. When you have a trend line break or support level break, it's either objective to short the break or a back test to that level. So it's very common when you break down. Now, as I said earlier, I would also not short, and this is just me. I wouldn't short above there. And if you want to keep stops tight, either a solid. When I say a solid 60-minute close, that means you don't have to squint and let's see, is that candle above it or below it? That's it's indeterminate. A solid close would look something up here, or even a daily close, and that helps to filter out the whipsaws. Now, the downside to giving yourself a daily close over an immediate break above a resistance level or a 60-minute close, pretty much the longer in the candle period you go out, then that leads potential for more losses. But again, it's what are you targeting? What are your thoughts? And I need to reiterate, especially for those vocal voices in the comment section lately, that I mean what I say. I'm highlighting levels that are key levels. Until that's broken, it's not going to open the door to the next move down. And so, if you are bullish or were bullish, you would have bought that yesterday. Kudos to anybody that had Meta or Amazon into earnings, particularly Meta, and of that too. Remember the Mag 7, as they call them now. We're seeing the continued narrowing of breadth. So I just want to reiterate. I see some giddiness last night from people that have been saying just kind of given up on shorting the market and said buy everything. Today, in no way, shape, or form changes my outlook of the market. In fact, it only reinforces what I'm seeing, and that's continued breadth deterioration. Okay, so where am I? Okay, other than we're at resistance, objective short, stop above, again, 60-minute or daily close if you want. And, and I'll probably throw my Qs away, my NQs, if that happens. And then I can always re-enter and move back down. But I still maintain, high confidence on the others, the ones that we have sell signals on lately. QQQ needs to take out that trend line. But the semis, we had sell signals with the bearish engulfing candles. IWM, or the small caps on that rally back to key resistance. And let me show you everything else I'm seeing today. So this is QQQ. And now, and again, it's the same story it's been for over a year now. Fewer and fewer stocks, these mega caps. It's almost becoming bubble-like portions. We've seen similar runs where, at the end of bull markets where fewer and fewer, and it's whatever the leaders are. Back, in 2007, it was the FANGs, F-A-N-G. Then, I renamed that the FANG, F-A-A-M-G. And now it's called the Mag 7. And you can see here clearly, if you just toggle over to QQQE, this is a party today that only Meta and, for the most part, again, guys, I'm generically speaking, that Meta and Amazon were invited to. Apple who was until very recently and has been for many years the largest company out there, largest of them all, is down after earnings, and it's still down year to date. So what I'm seeing is one by one the removal of that elite club. It was the Mag 7. I renamed it the Mag 5 lately, and I think at some point soon it'll go down to the Mag 3, 4, 3, and when you get down to the 2 or 1, then that's it. Now, again, anything's possible. If they pop this level, I told you yesterday, if we go much above those levels, it's probably going to open the door to new highs. Wouldn't surprise me one bit in the NASDAQ 100, but watch everything else. I'm going to get to those everything else. So you can see here, we've are and have been negative all day on the equal weighted. And another way to do this, here I'm going to show you, go over here to QQQ, and I'm going to move my little screen recording thing to show you a little bit more of the monitor. So over here, on the right, I have all the components of QQQ. I always have this sidebar. You don't see it when I do the videos. It's loaded. So any ETF, or most of them TC2000 has, or a sector that I key in on the main chart, it's going to show me the components. And I actually, on a screen above, I have the, another chart. And the same components are sorted by gainers or losers. So what I'm going to do here, I'm going to go back down. Put it where we were, and so these are sorted by market cap. So because these are the Mag 7, these are really the only thing that matters as far as trading NQ or QQQ. But then if you go like this and sort, is something I came up with years ago. I love this feature. I always wanted a way and figured it out many years back to have real-time market breadth statistics. Back years ago, you had to wait hourly. There were certain exchanges or certain sources that would report it, but on an hourly basis normally. And even then, it was only either the NYSE or sometimes you could get the S&P 500, but usually not, or the NASDAQ Composite, I think it was. But so I can do this in the XBI, the biotech ETF, if I wanted, and kind of get a pulse of the advancing decline issues in the biotech sector or whatever obscure sector, gold miner stocks, where those things are not published anywhere. And all you have to do here is you click on sort them by gainers or losers. So there's Meta, 20%, Amazon, and then scroll down like this. I need to do something here. I'm going to move the screen down a little so you can see in the very bottom. And I know I can't make this, I can, but I have to change the parameters of the chart. What it shows here are the numbers of items in here. And so in QQQ, you're seeing 98 items. Well, you might ask, Randy, it's a NASDAQ 100. Why are there 98 items? Well, it's 98 components in here. The numbers can change. You also have some like Alphabet. You have 2 share classes. Either over time, that number I've seen it can tweak up or down, but that's pretty much everything in the NASDAQ 100 right there, give or take. And of course, it's got all the big stuff. So when you do it that way, you follow me here. You have Meta at the top performer today. Go down here to the green stop, and I click on right there, SPLK. Splunk is the last, and it's flat. Actually, that's 0. So if I click this one, MAR, Marriott, that's the only one, the last one that's positive. There's actually another 0 there. Well, we'll just stop here. It's constantly changing. But what that tells me right there is, see down here, it says 41 out of 98 items. So what I did here is I clicked at the end of the gainers, and it tells me that less than half, roughly only 40% of the NASDAQ 100 are positive. You can even do, if you want a real depth of the market, like go to the NASDAQ Composite, and that has over 1,300 stocks in here, and you can do the same thing. You just scroll down until it stops going green. These are all 0. These are all flat. Here's the last one positive, and so that tells me out of 1,320 stocks in the NASDAQ Composite, showing me the components, only 363 are positive. That means almost 1,000 are in the red. So, all right, guys, I'm just trying to show you it's the same old, fewer and fewer stocks. And, history doesn't always repeat, but it often rhymes. And it's just a signature of an unhealthy market that, and the guys, everyone's cheering, the Meta earnings and all that. And on that, I wanted to address, somebody said, oh, Randy, your Meta, since you put it out there as a short setup is up to 20% today. By the way, Meta is not and will not be a short until the trend line breaks. There's the primary uptrend line. So it's wedging higher, wedging, it's still divergent high. And this right here, this big white line, super well defined. So I'm not short Meta, and I don't know anyone that is right now. It needs to break the primary uptrend line. That's off the November low. I'm trying to get a line tool here. There we go. There it is, and a clean draw right there. So you've got a lot of reactions on that trend line, and it's still above the trend line. And again, it's it's showing you just increasing narrow breadth driving the NASDAQ 100 up. We can even look at, I didn't pay attention to it. There's the NASDAQ composite right now. I've got a delay on that one. The S&P 500 is up 0.62, and then you look at the equal weighted S&P and it's down 0.5%. Same thing, you want real-time breadth on the S&P 500, scroll down here, you've got about, last positive one there, 148. Wow, that's pretty poor breadth, guys, for a day that the markets are green, the major indexes. So most likely, that's what people are seeing. And again, it just speaks to the overall health. More and more companies going down while fewer and fewer are doing the heavy lifting. So negative breadth, just like divergences, positive or negative, or just like overbought and oversold conditions. They're not buy and sell signals. They're just merely conditions that tell you what's likely to happen sooner than later if those conditions continue. In other words, negative market breadth usually precedes major tops and bottoms. And just as improving market breadth during a bear market or major decline, that's what you want to look for. Their internals getting better, or fewer and fewer stocks sinking. And so the same thing holds true in reverse. So that's it. So for QQQ, no change. We're right there. Objective short entry, whether you want to take it or not, add on. But again, if it pops there, doesn't mean it can't briefly pop and go down. And just, wait till we fail. At that point, wait till we break the trend line. I already have an alert on it. And I'll probably set another one. It doesn't matter. I have multiple alerts. Doesn't hurt, I should say. And that's it. Okay, so simple stuff. Now the stuff that I still, maintain shorts on. Let's look at the market leaders first. And I need to cue in another chart. Put this back where it was so you can see the chart. Go back to QQQ, sort them by market cap. Here we go. No, I'm on QQQE. There we go. Market cap should load. I have a snafu. Give me 1 second. Once in a while, TC2000 will quirk. It should sort them by market cap when I reloaded QQQ, and it's not, so I just have to do it manually. That's not hard, very easy to remember who those companies are. Let's just run through them real quick. And we'll look at a daily time frame because that's more relevant to the bigger picture. So there's Apple. Yesterday, I mentioned right here, very good support, and that's where we're at. So speaking to those that are bullish and believe that this market's going to go much higher from here, this is a great time. The last time I said it was a great time, and I even went so far to say, if you are bullish, those that are being very vocal and bullish on the site now or elsewhere, and hey, more power to you. I said this is the best time I've seen in quite a while, and if you don't buy Apple here, it's hard to figure out why, because you had all the positive divergence falling to support. It's the same support level, and we got the bounce. We got the bounce I was expecting, and then as I expected, it would be a small bounce that would get sold into, and we're back there. So if I was right back then, before we even fell, and this is where Apple was put as a long based on the 60-minute chart. I'm talking right here on this divergent low into this support zone right here, this whole support zone. Hit it, made another second successful test with even bigger divergence. So my point now is, if I was right in identifying 180.31, we'll call it 180-ish, as support before we even fell to it and bounced, and it hit and bounced twice, that further validates that level. It was identified, as support because of all these reactions back here, plus the 200-day moving averages. So I'm going to reiterate this. If you are bullish on the stock market and bullish on tech in general, this again is one of the should be one of the most objective long entries. So let's just put it that way. Am I buying it? No, but at the end of the day, who knows? I'll assess things. Sometimes I will take indirect hedges to a position. In other words, if I'm long or short NQ or QQQ, I might go long or short the best looking top components as an indirect hedge, because there are times where you can see QQQ or the NASDAQ 100 fall and one of those leaders is going up. Likewise, Tesla's a good example. Tesla's way off the highs. Tesla's been going down for the last couple of years while the market's been going up. And it was considered, they're still calling it part of the Mag 7. So there's an example, you could have been long the NASDAQ in short Tesla, or even now long Tesla. It hit support the other day. But this is it. I'm just posting analysis. I'm telling you we're back at support. This is what happened last time Apple reported. We had a drop when the technicals were bearish. Remember, guys, I say this often. Heading into earnings, and I love to play this game every quarter when we have big earnings, I'll go through these stocks, and if a chart is clearly bullish or clearly bearish, that, in my opinion, is the next trend after earnings. So here's the last few earnings. We had earnings on August 3rd. We had a beautiful bearish rising wedge. I was putting Apple as a short. We broke down, and we had all of this. It didn't stop till right here. There was our next earnings, November, on this purple line right here. And you can see we had strong positive divergence. In fact, I was long and bullish Apple there. That's when we closed out all shorts, because remember, we hit remember these purple lines that I have on all the Mag 7? And so we hit it there. And I addressed the fact that Apple had slightly pierced the 200s. And I said that's pretty normal to see them sometimes go through and pierce it. But collectively, the Mag 7 were all, collectively, the majority were either on or right above their key 200-day moving averages, and most of them hit almost to the button, those purple lines I had. So again, here's the thing. We went long Apple right there, and I was bullish the stock right before earnings, and what was the post-earnings trend? Clearly up, right? We ended there with a bearish rising wedge. We went down. Now, this time around, it's a little more indifferent, because right here, if they would have reported right here, when this bearish rising wedge broke and we shorted Apple, I would have been more bearish, right? Because that was a clearly bearish technical setup. The $1 million question, was that enough to, satisfy this wedge? In my opinion, I'm going to tell you, no, I don't think so. Oh, by the way, we already bounced off that. That candle was red earlier, just showing that the Apple was still negative. You hit that 180, and I identified that in yesterday's video. The 200-day moving averages, look at that, the red line, perfect 180. So if you bought Apple on that dip this morning, you already made 3.5%. Now, the $1 million question was, will it hold? I don't know. I don't think so. I believe there's more based on not just this daily chart, but more so the weekly chart on Apple and everything else. And there's that big, very important primary uptrend line off the 03 lows, just a little below. So I still maintain, whether we go a little higher first, a little higher could even be a new high or not. That's where Apple's ultimately headed, probably this year, no later than next, in my opinion. However, and this is the big however, and this is where people sometimes don't listen, Apple isn't going to go anywhere until it breaks support. Right now, it hit support today. There was a support outlined in advance. It hit not just very, very good, now even better price support, because we've had now 3, and today was a third reaction in the last month or two. Another reaction. So that further solidifies or defines that support level. And the 200-day. If you are a bull and Apple pulls back to the 200-day and you don't buy Apple, I don't know what to tell you, because I covered that for many years. It behaves very well for decades off the 200, meaning when you're in a bear market or bear trend, rallies back to the 200s usually are where it will fail. And in a bull market, pullbacks to the 200, you want to buy it. So there's that. And so that's all I can say. It was objective today at 180. However, I can say on the flip side with a high degree of confidence that if and when Apple breaks it, a solid break, especially a solid daily close down below 180, will have done two things, at least at minimum. It will have taken out that very good horizontal support that I've been talking about, and it will clearly have taken out the 200-day moving averages. Does that guarantee Apple will go down? Well, these are still the levels that when taking out, again, when the majority of the Mag 7 have taken out my purple lines, those key support levels, that's where, in my opinion, the odds will go to very, very high that we're going to hit those aggressive downside bear market targets I have for a lot of these, including 40+% on the indexes, and many of these stocks probably losing that much or more in value. But again, as of now, maybe we break 180 and we go down and we test this level again. If we do and you're bullish, then that's where you want to step in and buy with a stop somewhat above. And if you're bearish, that's where you want to wait for that to break and add to your position. Just like right now, if you were bullish, you should have bought today. If you didn't, then you're not doing this properly. If you believe the market's going higher and you didn't buy Apple at 180, then again, I don't know where you buy it. Or do you want to buy it, after it's run up and you see that level is successfully held and now you have another overbought condition and divergent high? No, you got to buy when no one else wants to buy. And you have to short when everyone else wants to buy and nobody wants to short. That's typically how you're going to do well in this game. So that's it. I don't want to spend too much time on Apple, but it's important because Apple was, remember, we keep hitting the $3 trillion kiss of death. Microsoft just hit it, where I have a board somewhere for you here. I keep pointing it out every time we get there. This is when Apple, it's those round numbers like kiss of death. January 3rd, 2022, right here. This is when Apple crossed the $3 trillion mark for the first time. I highlighted it there. It was a kiss of death. If you bought the headline, and the arrow was a day it did it. Then we went in, and sure enough, it dropped 33%, a third of value lost. Then it hit it again there, and that happened. It hit it again there, and I pointed it out there. And so far, again, it's been the kiss of death. It's a round number. It shouldn't really matter, but it seems to for whatever reason. It's just been a ceiling for Apple, and I'm sure it'll end up being that for Microsoft. Now let's just go through the rest. Let me see if my components. Oh, now they loaded. Okay, I'm talking on the sidebar. Okay, Microsoft. Bearish engulfing candle. No, not a bearish engulfing candle. Trendline break below the bearish rising wedge. And it's simple. So if you want to trade individual stocks right now, you're doing much, much better. Because again, until Qs take out that trend line, there's no, the stronger case to be made is trading these individually. And so Microsoft, was a sell signal there. And there's another example. Well, it hasn't played out yet. There was earnings. Leading into earnings, this was clearly bearish with the big divergences. We broke the trend line, and so far we're still well above it. So if you're trading just Microsoft, your stop should be a little just above that candle, the recent highs. At the very least, above a full solid recovery back above here. You can allow for a back test of that trend line. That might do the trick. But if you get above it anytime soon, then really it kind of mucks things up. It just... again, if this is trading a wedge, you short the breakdown or the back test with stops above, and your target, like I said, down here, minimum 376.35, then 364.54. Your 200 days are all the way down here. Microsoft hasn't visited the 200 since back here, so that one is most likely going to do it sooner than later. So there's Microsoft on we get a check mark for Microsoft. We have a check mark for Apple because it already rolled off the high, but I'm not going to give it the check mark just yet because I want it to break that support we hit today. So I'm just doing this as of today, which ones have check marks. So for the bearish case, check mark on Microsoft, Apple still pending there. Break below today's lows pretty much will do the trick. Give us that check mark. Alphabet today has broken down. So you can see I have a trend line here. It's a little bit of a busy board. I'll clean it up for you. I just draw it out. Alphabet right there. There's your breakdown today. And let's see. So right now, of the Mag 7, by the way, we have Microsoft up, Apple down. I'm just looking over there at the thing. Alphabet down, Amazon up, Nvidia up, Meta up, and Tesla down. So only a little over half, 4 of the 7 Mag 7 are up today. I just want to point that out. So that's it. So check mark. Now, look, I know I did. I covered this the other day. I said, look, we had a trend line in Alphabet, but you also have very good price support there. That's what I call BOD, or benefit of the doubt. It's about 139-ish, and that was a very, very important high. We were consolidating here for months. So this is the breakout right here. This is just the back test. So I'm not going to give this one a check mark, even though we're below the trend line, because you've heard me say it if you followed me for a while. 2 support levels in close proximity. I wait for the second one to break, because I call that the BOD, or benefit of the doubt, support level. And you can see we had a little brief pierce intraday, but we're still above it right now. So we need to, to give it safe, to give yourself a little safety, or a little wiggle room. Wait for a break of today's lows, or a close down, a solid close below that trend line. Amazon. No, I addressed this yesterday. I highlighted the fact we broke down, but I said you got to take it with a big grain of salt, because a breakdown that occurs right in front of earnings can and often does get rejected. Now, the chart is bearish. This is just one day here. When I talk about the post earnings where it's going to go, first of all, that's not 100%. I give you my opinion. They're not all going to pan out, but I also say this is just post earnings noise. The major trend, when I look at the weekly chart of Amazon, here's what I see. I'm going to move this line up now. That's my divergence line. I see the first divergent high. I see the potential, if it wants to keep going up, to maybe burn through these divergences. As of now, it's still there, but it's also what I call unconfirmed divergence. For me, and it's just something I made up years ago, but I like to see a bearish PPO crossover at lower levels. So this blue line has to come down here and cross the signal line to officially give me what I call confirmed divergence. This is only what I call potential divergence. Potential, because this is a momentum indicator, and it's clearly pointed higher right now. And so I need to see it roll over and not just blip down. I like to see the crossover. That's usually a good sign there. It's, to me, again, that's where the divergence will be confirmed. Now, so for the bulls out there, in the bullish case, yeah, if it keeps doing that and we take out the previous highs, then we no longer have that divergence there. But unless we do, this is how I trade. This is my trading style, or my technical analysis style. When I see these big divergences, especially on the weekly chart, they lead to the big trends. This was that divergence, and it took a while to play out, just like right now. That's where I think people just don't have patience on looking at these longer term charts, the daily and the weekly. Weekly charts, divergences usually build for over a year, quite often 2-3 years. That was ultimately those divergences and overbought conditions manifested in almost a 60% drop in Amazon. Right there, 36% drop. Right there was a very small divergence, but still got a 14% drop, 32% drop. Again, off all the divergences, you can see, and there are bigger ones back here. The stock split and all the lines went running up there. That's one annoying thing about TC2000. As good as the charting platform is, for the life of me, I can't understand why they can't just code it to adjust, your annotations for stock splits. Every time a stock splits, you got to move everything around. All righty. Nvidia's Nvidia. Again, no sell signals on Nvidia until we did break this trend line, but now we're going up. Maybe we want to back test. The big level on Nvidia remains, well, I have my purple lines here. That's my, some of them I have 2, because the first one probably will do the trick, but the second one is where I feel highly confident that'll do the trick. So we're way, way above those right now. But in the near term, this is a very important level. So if Nvidia were to correct, it's at 653 now. It'd be a pretty heavy correction, but 500, and I put good odds for it. We still have sell signals on the semis right now. I'm kind of segueing into that. 503-ish. That's a big, big level. You can see Nvidia here had almost a year, good half year or more, of a very tight sideways trading range, and there's your breakout candle, and it hasn't looked back. So if we get some downside anytime soon, in a correction, and you're in an NVIDIA bull and this thing hasn't let you in, you buy it at 500. If that doesn't work, you can try these 200 days or the purple lines. But look, to get there, just to get there, and I believe we will, NVIDIA is going to have to drop 40%, 42% from where we're at today just to get down to my 375 level. Just to get back to that 500 level, it's going to be a 22% drop. So now that I've got two more Mag 7s. Meta is not I don't see any sell signals. I haven't seen any sell signals in a while, so I want to make that clear to the comment that was made. It was a short setup. A short setup, there's a big difference between an actionable trade, a short trade that's actionable, a break that already triggered a sell signal, and one that's a setup. This is just a setup, and it will remain a setup until it is a setup until that trend line's broken, then it's an active trade. This is what it looks like on the weekly, and we'll see how the week finishes. So one more in the group, what I call formerly known as the Mag 7, because Tesla peaked all the way back in 2021. Let's not forget we're in the year 2024 right now. And like I said, it's a good support, and this is one I think in the near term, the downside's probably limited. But again, I made that clear yesterday because somebody asked. I don't care to buy this one right now. I can't, just looking at the chart, I can't make a strong case. Yeah, it's very overbought. That's one check mark. Last time it was at overbought was right there. And if it pops this trend line, so look, guys, if Qs do punch out, let's say we do punch out the new highs here soon in QQQ, and what you want to see. It would help to see more improvement in the internals. So you can either do what I did, sort the watch list of QQQ or the NASDAQ 100 and the S&P 500, or you want to keep it simple. Just look at the equal weighted. Look at QQQE, RSP, watch those equal weighted indexes, see how they do. And then, as I mentioned the other day, Tesla, you could certainly make an objective case to step in there, but maybe at most, maybe a half position with a stop somewhat below, and then add to it if it takes out that trend line. And you can probably see that trend line a little better if you drew it on the 60-minute chart. That's often what you can see right there. That's probably the best fit. Yeah, something along those lines. It would help. See, here's a case where divergences don't plan out. You can see I put a little X there. Divergent low, divergent low, divergent low. So as I often say, most of the time these divergent lows end and divergent highs end in trend reversals, but not always. And there's a good example. This stock has just been under selling pressure. And it just remains entrenched in a downtrend. Okay, I said I'd segue over to the semis, SOXX, kind of different from the rest of the lot, but it's still very, very much intact. I highlighted this bearish engulfing candle over a week ago now, and we're still very much below it. So if you shorted that, you could lower your stop at this point, but if you're swinging for the fences, trying to hit a triple or a home run, and you're going for the much deeper targets I have on the semis, yeah, you'd want to keep a wide stop because look, we just hit trendline support. And for those of you that are very bullish right now and think the market's going much higher, just like QQQ, this is when you want to buy. So there's the only trade that I have seen in SOXX, only two trades. I saw a objective short here after the bearish engulfing candle. And in the last 3 days, it's been an objective time to either cover that short as an active trader and or go long, because again, TA 101, it's not just an uptrend line, and it's a very well-defined uptrend line, and it's an uptrend line that happens to coincide perfectly with the QQQ uptrend line. And you also have price support, the previous reaction high, the breakout candle right there. So this is again TA 101 if you're a bullish buy. To me, it's kind of picking up nickels in front of a steamroller thing. When you start to wedge higher and get overbought, sooner or later, tap, 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 that trend line's going to break. But it's a simple strategy. Buy it. Maybe we go up here. Maybe we only go up to here. And then you can put a stop somewhat below that trend line, and that protects your downside if the trend line does break. So again, these are key levels. Take them, don't take them. Remember that SOXX has a high weighting, probably chock full of NVIDIA or whatever else. Quite a few of the other semiconductor sectors, ETFs, especially this one. This is going to probably be a much more diversified. The S&P spiders, they tend to be more broadly diversified than other ETFs. So when you notice when I do my 11 sectors of the S&P 500, I use the S&P spiders ETFs to cover those sectors because that's the same company, S&P Standard & Poor's, that's doing the S&P 500. So I'm going to assume that their sector ETFs are more indicative of the 11 sectors that they include into the S&P 500. So my point is this is a better representation of the overall health of the semiconductor sector. And like I mentioned, it peaked back here. Now, any ETFs that happen to be top heavy in NVIDIA are going to show new highs, just like QQQ is showing new highs. But this one peaked back in late 2021, early 2022, right there when the stock market peaked. And again, it's been swing tradable, divergent high, drop, divergent low, rally, divergent high, correction. Walked up, here was a trend line break, little minor uptrend line, divergent high, drop. Then we broke that secondary trend line. In fact, if I extend this trend line forward, look at that, how perfect that is. I love technical analysis. It never fails to amaze me how often these key levels work. So I just extended out that previous trend line I had from way back when, which gave us a sell signal here. And this is just a back test. And when we back tested it, you had two reasons to short the semis there. Number one, the fact you had negative divergence here on the daily chart and the divergent high. And number two, the back test. Then you had a sell signal breakdown right there. And then the other day, as I mentioned, and across the board, a lot of semis, you had a massive bearish engulfing candle. In fact, the next candle also engulfed these two previous candles. So, and we've been moving lower. But just like Apple and a lot of things, and QQQ, big support right there. So again, I'm doing this video, set these alerts. Whether you're a bull, if you're a bull, you want to be buying here because you are at support on a lot of tech stocks and a lot of tech indexes and sectors like this. And if you're a bear, you don't short right here. Well, you can based on that QQQ bounce back. Again, look at different time frames, different charts. But ideally, especially for a swing trader, somebody looking for a much bigger move, this is what you want to see. So I set that price alert on XSD, call it 207. Note that you do have the 200 days just a little below, so benefit of the doubt. You can see when we rallied up to them here, you consolidated on the 200 simple for a while. They were support, then you finally broke that support level, back test, couldn't get through, rejected. Tried up here, tried for several weeks, finally a breakout candle. So I would expect most likely the buyers to come in there. I'm going to put a line there as well. I just want to mark this chart up because I'm following the semis closely. There's that period of consolidation, and that's the top of it right there. So it's price support about 202 and the 200 days. So sell signal 1 on a break under 207, and even a better sell signal on a break under 200. If the 200-day moving averages and the 200 price support are clearly taken out, that will most likely open the door to a much bigger drop in the semis. And then the other one is SMH. And this one here, SMH, it's got a lot of NVIDIA in it, I know that. And, well, this is it, a little resistance level there. There's your uptrend line. You can see they're all different. Some are at the uptrend line support right now. Because these are all semiconductor sector ETFs, but each company gets to decide which semis they put in and which weighting they give to them. So they're not all equal. Like I said, XSD is probably, and I can tell you right now, I'm looking at it on the side here. You can see it has 39 components in there, whereas SMH only has 25. Let's see what SOX has. I'm curious. 24 on SOXX. So you can see that XSD is a much more diversified semiconductor sector ETF. And so that makes it more representative, really, of the overall health of the semis versus just NVIDIA, which is still the poster child of the AI hype bubble. Last but not least, okay, that's a pretty thorough update of the equity markets, really the NASDAQ 100 and the FANGs and the semis. And then you have, of course, your The other two of the big three, and that's the euro US dollar pair. Euro got smacked down hard. So you remember in yesterday's updates and in the last few days, I've been highlighting we hit that pullback target, that primary uptrend line off the September 2022 lows. After putting in that divergent high, that was the technical catalyst that sent us down here. Took out the minor trend line, continued on down. And so yesterday I said for the euro to run, and that would be a net tailwind for stocks. It needs to break this trend line. It could still do it. But what happened is today's strong jobs report sent the euro spiraling down pretty hard. That's a pretty hard down, 0.78 right now. Here's what it looked like this morning. There's where the jobs report came by. So probably know what I'm going to say is right now the euro did this, and the stock market, particularly the tech-heavy QQQ and even S&P 500, remember, is tech-heavy. Tech is by far the largest component, largest sector in the S&P 500. In fact, it's nearly double in size that it represents the weighting of the next largest. And so if and unless, now look, we're at support. I just showed you, and I showed it to you yesterday, and we're back to that support. So we're in a very precarious technical posture. Watch this. I can't promise you which way it's going to happen, but I suspect we could see. I mean, today's what happened, if you're not familiar, the hot jobs number just really, Powell already took the March cut off the table. He was pretty firm. And now I have to imagine there was a pretty drastic move in the federal funds futures based on today's hot jobs number. And so it's one of those comedic things where you're probably perplexed. Oh my God, why isn't a more bullish than expected jobs number positive? It should be positive for the economy. More people have jobs, more people are working, they're going to spend money. Consumer spending is 2/3 of GDP. Well, not right now. The most important thing is that remember, there's a massive amount. I heard the numbers around $1 trillion in debt coming through due in 2024, commercial debt that's got to roll over. And a lot of these companies' credit conditions have tightened since then. Rates are still, as much as they've come down off the highs, they're still infinitely higher, exponentially higher than they were back when a lot of these companies took them out. Remember, we were running at a zero interest rate policy for many years. And so interest rates are going to be everything. So if the euro breaks down here, that's going to be net bearish for stocks. And we're at very good support right now. If I had to flip a coin and bet, I'd say we probably bounce. It's been good. It's a really good support. But if we don't, then we go down, and that's going to support the case that the stock market's going to go down sooner than later. If the euro can hold this support and break out of the downtrend line, it will probably equate with marginal new high, a little bit higher highs in the S&P and NASDAQ 100. And you can see I have resistance up here around that level. I'm going to move that right now. I'm going to readjust that resistance level to about 109, 153 if you want to watch that. Okay, so there's the euro. There's your update there. And there's another case. It just keeps putting in divergent lows. It just can't catch a bid, but the divergence is still there. So it keeps me a little cautious, if you will. It's just what I've been saying for weeks now. It's not an all-in moment to short the market. Has not been for a long time. We need to see, some sell signals really on the majority of the Mag 7s, because until they die, they can single-handedly continue to lift the indexes. However, they're not in IWM. I'm going to get that in 1 second. Let me just cover Treasuries. TLT, yesterday I gave you an update on TLT. It was at resistance. I said, I don't have a strong opinion, but probably a pullback, because that was that potential second target on the daily time frame. Really good resistance, as I highlighted yesterday. Look at all these reactions. Boom, boom, boom. Then it broke it. Tried to get above it, couldn't hold it. Broke the trend line, went down. And so what this is a big drop, 2.5% in TLT. Again, the market is not getting this memo. Let me show you what I'm talking about here. Edit chart properties, QQQ. This is it. So typically you can see the correlation here as I overlay the lines with when bonds, TLT is falling, rates are going up, and the NASDAQ is falling. The white line's the NASDAQ composite, or NASDAQ 100. Rates bottomed here in October. The stock market bottomed. The green and red candles are TLT. That means bond prices are going up, which means rates were falling. The stock market was ripping because of it. Right there, we had a pullback and bond yields change. Rates started falling. We had a correction in stocks. But from about this point here, you can see there's this disconnect. And today there's a sharp disconnect. So the market right now, people buying QQQ either are oblivious to this or they're cognizant of it and they're just dismissive, saying it's a one-day blip. We're going to see rates continue to fall and bonds come back up. But history shows us that the longer these divergences continue, meaning bonds down, which is rates up, and stocks up, one or the other is going to play a game of catch up. So keep that in mind. So what I was pointing out today, we have not just little bit, but pretty significant drops in bonds, a spike in bond yields. And let me show you IEF as well, the 10-year. Let me turn off that comparison for QQQ. All right, so here's IEF, 10-year. This is that divergence line. Remember, I was drawing it here, showing you we have resistance up here at 97.50-ish. There's a little reaction high there. And maybe we still get up there, but right now I can put my divergence line. That is a higher high yesterday and clear negative divergence. So this is important, guys. We had a sell signal here on a break of a trend line, but what we were lacking was negative divergence, and we still got a correction. Now, as of yesterday, we put in a divergent high. And just like the stock market, if it wants to go up a little more, anytime soon, that is, if it goes up a lot more or it takes a while to do it, then we may not have the divergence. But anytime soon, should this just be a one-day blip and bond yields fall and we spike up here to this range, anything in here-ish will still have that negative divergence. And that's probably going to set the stage for a potential bigger drop. Where to? Well, you can see I have a primary downtrend line coming in on IEF, which again is the 10-year bond right here. Downtrend line. So what this could be, big divergent low. Remember, we were bullish and long there. Breakout, and we might be looking for a back test. And so if that's the case, a back test in the 10-year means rates go up, and you will see the market start to freak out if we get anywhere near this recent level. And that's right about the time we'll probably bounce. Again, that's a scenario, and I'll say that's my preferred scenario. In fact, we had the divergent high, so let's just draw from here. Let's say this is my preferred scenario for Treasury yields. This, and then this be my alternative scenario. Maybe one more thrust up in bond prices, another drop in yields. But that's my alternative right now. If we start to run up here, then that becomes my primary. So this is not contradictory analysis. They both have it. In both cases, I think we'll have this pullback most likely. But I'm also, my convictions, and I'm not in bonds right now, is not super strong, because if something happens and the market really starts to roll over hard and we finally break all the rest of the Mag 7, you could see that flight to safety bid in Treasuries, where institutions are buying Treasuries, causing prices to go up and yields down. So I'm watching and I'm giving you analysis on Treasury bonds. You're welcome to trade them if you want. Obviously, you're welcome to trade anything you want, but I'm watching this more so because I'm pointing out today the red flags in today's stock market rally with a big drop in Treasury bonds and the euro, yet stocks are rallying like it's 1999, or at least tech stocks are. And finally, that brings me to the last one, loop back to the first part of the big three, the equity markets. There's IWM. Here's another example. What is today's hot economic employment number mean? Well, it means it decreases the scope and magnitude of the dot plot of the rate cuts we're expecting from the Fed as of now. And what does that impact the most? Well, small caps. Meta doesn't need to go out and borrow money to finance operations. They get plenty of cash coming through, as all the Mag 7. That's why they are the Mag 7. They're cash cows. However, small caps are more dependent. Now, that's just the fundamental reason, but so you can see it also shows you what's going on in the market. The NASDAQ is up, what, 1% or something today, and you have the small caps down 0.63% as I'm doing this. And I highlighted recently both an objective, albeit aggressive short on the breakout, because I put high probability that breakout would fail for all the reasons I covered recently in recent videos. Then when it did fail and then took out the trend line, that was an objective short or add-on if you were already short. And then I highlighted again the other day, any pushbacks to this level. This is the top of a massive trading range, a trading range that I expect now that the breakout has failed. The next stop will be, like I said the other day, even when we were right here, I said I wouldn't short it now. This was your short op. If anything, you're going to get a bounce soon. And we got that bounce. So I just wanted to point out this short trade is still intact and still looks good. Is it going to help if the NASDAQ continues on and holds these and builds on today's gains? No, it's probably you're going to get some sympathetic buying. The small caps are a risk on index, and people tend to buy them when they see the risk on QQQ going up. But with that being said, from a pure technical perspective, I throw a lot out here and it can make your head spin. Sometimes it makes my head spin. Keep it simple. That was objective short 1. Objective short 2 the other day, and it's still a stop above these levels. Maximum stop would be above that high. Well, I think I said the other day maximum would be above that 208.48, because that's also big resistance if you are positioning for a much, much larger drop. I tend to be more of an active trader, even if I think we're going down, way down here. I'm going to be, this is, I'll micro trade, I call it, off the 60-minute and daily charts and stuff like that. All right, so that's it. So we have, like I said, semis. The semiconductor sector itself remains, on a sell signal below those bearish engulfing candles. Small caps remain on a sell signal, but we still don't have sell signals on most of the Mag 7 and or QQQ, which remains above that uptrend line I've been pointing out. And so that's what we need to break, the uptrend line, and then 413. And that should bring us down quite a bit, probably for a back test of this level here. That would be your swing target if you're 395 and then 383-ish right there, if and when. But no sell signal, no objective short entry, other than, again, for active traders want to short a bounce. And right now, look and see, we're starting to move above it. This candle hasn't finalized yet, so that's a no-go. In fact, I'm more interested in reducing or stopping out, especially on an active trade account. If you shorted there, that's, again, keep your stops relatively tight. If it falls back below, especially below the trend line, you can always re-enter. So there it is, guys. That's what we're looking at here. And I will do most certainly another update today, whether it is another video. I know there's a lot of other stuff out there, and those are the things I want to get to. Obviously, the metals are down today because they're getting a note that the euro is down. They trade on it. Whatever else, I don't know. I'll dig into the charts. Like I said, I just got back to my desk and started the video right away. So let me catch up on things, and I'll get another one out to you. This has been Randy Finney with Right Side of the Chart.